Well, hi everybody, and thanks very much to Barry. It's a pleasure to be here, and it's always wonderful to share a stage with Chip. We actually share something else as well, which is I am a Wellesley grad. I'm not an economist, probably because I finished there right about the time that Chip was starting. So I'm going to talk to you today not from the perspective of an economist or even from the perspective of a national perspective. I really want to talk to you about what's happening on the ground and how all that feeds into the kinds of things that Barry and Chip were talking about. First, maybe I ought to take a minute and explain what Boston Community Capital is. Let me just ask, do any folks here know, or any of you familiar with Boston Community Capital? Oh, I'm delighted to see it go. So what we are, we're what's called a community development financial institution. And what that means is we're part of a national industry of community finance institutions that are not regulated the way banks are out working in low-income communities and really trying to provide all of the various tools and instruments of finance to those communities in ways that banks are sometimes unable or unwilling to do. I like to say that we try to function at the intersection of downtown and community values and downtown expertise, and we have a real sense that the communities in which we all live and attempt to serve have a right to every single bit as much expertise and skill as wealthier communities in this country. And I spent a decade or so as a real estate lawyer actually at one of our big downtown firms. And I've often said it was fun making money for rich people. It's way more fun solving some of these issues for lower income folks. So I want to go back a little bit and explain something about how we came to the foreclosure crisis and where we actually see it going, what we think is happening. Back in 2006 or so, really, as Chip was saying, you could see that housing prices were skyrocketing, and when you looked at incomes in the neighborhoods, they were really as flat as they'd ever been. And we moved away from any form of underwriting whatsoever. And so we're down in Dudley, we were kind of scratching our heads about this and getting more and more and more worried about what was going to happen. So we decided to set up a mortgage brokerage, thinking that perhaps as rates came down, we could help folks finance themselves out of the mortgages that they were in. And what happened is we must have gotten 50 or 100 different mortgage applications, and what we discovered was that people's level of mortgage finance, the amount of money that they owed, was so far and away more than they could ever possibly afford to pay that there wasn't any way to refinance them. My favorite, or perhaps least favorite story, depending on your point of view, is a woman came in, she's a hairdresser, worked in one of the local salons, and she made about $23,000 a year. And she had a mortgage for $323,000. Now, I don't care what the interest rate is. I don't even care how long the duration is. She could have put 100% of her income toward that mortgage, and she would have been behind. That's before dinner. So there was no way. And so we began to look at that and really began to realize that this problem was mushrooming. At the same time, of course, we were listening to some of the folks out of Washington saying, oh, this isn't really much of a problem. We think it'll top out at about $200 billion. I think that was chair of the Federal Reserve, who I have a great deal of respect for. But there was really we had this extraordinary sense of a massive disconnect between what we were seeing on the street and what we were hearing on the radio. It just didn't make any sense at all. And so as we continued to move forward, and of course then the crash began to occur, we started to really go out and try and understand what the foreclosure crisis in the greater Boston area looked like. And what we discovered, and I think this will probably not be a surprise to very many people, it's changing somewhat now, but it still is very much this. Most of the foreclosures were focused on low-income communities, particularly if you looked at Roxbury and Dorchester and Mattapan and Hyde Park and East Boston, Revere, Chelsea, all of the areas around that we think of typically as more low-income areas. Not surprisingly, those low-income areas were just about coterminous with communities of color. So that when you looked at where folks were living, they were living in the areas that were low income, that were hardest hit by foreclosure. And the foreclosure issues were partly about these steeply rising home prices, with which income had not kept pace, but they were also about the kind of mortgages that people actually had. Lots of them were what we describe as predatory mortgages, and Chip mentioned the 2 and 28s. I don't know how many folks here are familiar with this, but basically what happens is you get one rate for the first 2 years, and then the thing jumps up for the next 28 years. And since nobody was really underwriting, it didn't really matter what you qualified for anyway. So And so people would go in to a mortgage broker, and they thought that mortgage broker was their advocate. They thought the mortgage broker was an expert. They thought the mortgage broker was an advocate. In truth, all the mortgage broker was doing was selling the product that Wall Street had created. Right? There's been an awful lot of attempt to pin the blame on the mortgage brokers. Lord knows there's enough blame to go around here. But the truth of it is that some of the Wall Street folks had created a set of products that they absolutely knew or should have known were going to cause harm to the communities, because these products were such that nobody in the entire chain of creating them had any stake in the outcome. So I look around, I see Elise as much gray hair as I have. When I got my first mortgage way back when, I knew that the community bank that I was getting that mortgage from had the mortgage on its balance sheet, and if I didn't pay it, they were going to take a hit. And we were very much alive in that sense, right? They needed me to be able to pay it, and I needed to be able to pay it. By the time we got into sort of post-2000, 2005 to 2010, most of the mortgages that were being originated were simply passing through the mortgage broker, the originating lender, and so forth, and going off into these securitized pools, so that none of the folks who were actually touching the mortgage as it was being originated had any interest in whether it was paid over time. Who really has an interest in whether it's paid over time? Well, if anybody here has got a pension, a 401k plan, one share in a mutual fund, you have an interest. I have an interest. In fact, what's happened, and in a sense this is maybe a more positive way of saying it, we've actually socialized the risk of all of those mortgages being unpaid. The problem is the risk has gotten put out onto all of us, but the issues around how those mortgages are priced and how they're originated and what the terms are not with all of us. And then the other thing that we began to see is in the greater Boston area, I think prices and values on balance were down plus or minus 15%. But when you looked in the neighborhoods, because the run-up had been so high, values were actually down 50 to 70%. So you could look out at a place like Lynn, and they were down about 72% there. And we're seeing 50% reductions in value all over the lower income neighborhoods in Boston. So when you looked at that, what you discovered was you had a whole bunch of people who had a mortgage that was now maybe worth twice the value of their home. They had no capacity to pay it in terms of what their income was, and there was nobody to buy it from them because there was very little credit available. And it's just not typically the case that somebody from Western and Brookline decides really they want to live in Roxbury and they can come in with their income and credit score, right? I mean, typically the buyer is the classic buyer for the neighborhood. You sort of think about who that average buyer is, and what you're looking at is somebody who could afford a price at market today, but market today is only half what the mortgage on that house was. This was a very big problem. So we set out to try and think about what we could do to solve the problem, and we first tried to buy some portfolios of these mortgages and found that the lenders and services, anybody interested in selling a portfolio, had a wildly unrealistic idea about the value of that portfolio. In fact, they were interested in selling it about 65 cents on the dollar. And I'm sort of sitting here saying, well, I know values are down 50%, and you're asking me to buy a pig in the poke for 65 cents. Maybe that's a good deal for someone, but I don't think I could do that. So what we finally decided we were going to do was raise our own pool of money, go out, underwrite people who actually were in foreclosure, attempt to buy up homes at steeply discounted prices from the lenders or services or asset managers who had them, and refinance folks into new homes. So let me unpack that a little bit. So right now, say I'm living in Roxbury, and I have a home that costs, with a mortgage on it, of maybe $350,000. If I get underwritten according to traditional underwriting criteria, I can probably afford something that's in the nature of $150 to $175. When you look at market value for homes in those areas, there are really two different market values. One market value is for what a distressed home will bring, that is a home that's in foreclosure, and the other market value, which tends to be 25 or 30% higher, is what somebody would pay for the home if in fact they were simply buying it in an ordinary transaction. So what we did was to go out and the first way that we did it, we simply put a pool of our own money that we had generated over time through fees and other things, and to try and kind of figure out this process. But before we did that, actually, I should just step back for a second. One of the things that we did was we said, well, whenever anybody's trying to figure out what a market needs, what do? They go ask the market, right? They hold focus groups. Well, I don't know how many people decide to hold focus groups for people who are in foreclosure, but we did. We held focus groups here in Boston, and we held focus groups down in Fall River, New Bedford. We got a whole bunch of folks in the room, and we said to them, how did you get into trouble in the first place? And what do you need to get back out of trouble again? And it was a really very interesting set of things that came out. People said things like, I never bought a home before. I went to the first-time home buyer classes. They said, oh, you can do it. But the truth is we couldn't do it. We didn't have enough money to get through any negative experience, any negative financial experience in the family. So for example, if anybody lost a job even for a month, there wasn't enough money to pay the mortgage. If a spouse or a child gets sick, there wasn't enough money to pay the mortgage. If something happened in Haiti, as it did, and more money had to go there to support family members there wasn't enough money to pay the mortgage. And there was nowhere that anybody could get cash from to help them over a short period of time. We also heard a stunning number of stories about people who arranged for a mortgage, knew what the price was going to be, got to the closing, and discovered that what they thought they were going to pay on a monthly basis was now several $100s higher. I think maybe one of the worst stories of that I heard was someone came in and said she knew it was going to be $1,300. She got there, she discovered it was going to be $1,700. Now you should understand, this was only the teaser rate. It was eventually going to go up way higher than that too. She said, we can't possibly pay $1,700. Her husband said, don't worry, I'll get a second job. And as she sat there in this room full of other people in foreclosure, she said, now I don't have a home and I don't have a husband. And so you saw that kind of thing going on all through the process. So we started to think about what kinds of provisions mortgages needed to have in order to really serve the needs of lower income people. And what seemed clear to us is they had to be properly priced, and that didn't mean simply reducing an interest rate or extending the term of a loan. It really meant steep reductions in principal. It also had to have provisions in it whereby, if necessary, you could work with somebody to put payments onto the back end if that were needed. It needed to have appropriate loan loss reserves. It needed to have reserves up front for taxes and insurance, and in the case of condominiums, for condominium fees. And interestingly enough, and this was something we struggled with for a long time, it needed not to piss off all the neighbors. And let me explain that a little bit, okay? So the very first loan that we did was somebody in a development with about, 200 condominium units. And she had paid, I think, $300,000 for her condominium. And everybody else in the facility was paying roughly $300,000, and people were working 2 jobs and doing other kinds of things in order to maintain that payment. But she couldn't pay $300,000. What she could pay was about $150,000. And as her neighbors began to get wind of this, they got really angry. And they said, now look, we're paying $300,000, we're extending ourselves in all kinds of ways to do that. How come this person over here is going to do this for $150,000, and at the end of the day, it's going to have exactly the same benefit that we have? Now, there are a lot of answers to that, right? I mean, one thing you could do, and the analogy I sometimes use is to say, if you've got a home on a street of wooden structures and you accidentally light it on fire, right? When the fire department shows up, they don't say, oh geez, you should have been more careful, we're not going to put out the fire, right? Even if they wanted to say that, they wouldn't say it because all the other homes are going to burn down. So, you could say that having somebody in foreclosure or having a home go vacant reduces the value of all of the surrounding homes, and so people ought to just say, suck it up and say, okay, you're going to benefit and I don't. But that isn't what happens. What happens is everybody gets really angry. So, and then we were also worried about the issue of speculation. We didn't want folks coming in and saying, well, great, you can cut the mortgage in half, I'm just going to speculate here, and if I don't like it, I'll leave you holding the bag. So what we did is we put a thing onto the end of this mortgage called a shared appreciation second mortgage. And what it really means is, if what you're paying is roughly half what the original mortgage was, then come time of sale or refinance, what you get back is about half the appreciation. And there's a kind of a sense of rough justice about that. And when we tried that on with folks, both who were in foreclosure and folks who were living in neighborhoods that were hard hit by foreclosure, everybody was happy with it. The language in a mortgage is kind of complex. But the concept was easier, and everybody sort of understood that you paid what you could today, the home stayed occupied, it helped stabilize the neighborhoods because you didn't have a lot of vacant homes that then weren't generating real estate taxes and were becoming drug dens and were subject to what's euphemistically now known as urban mining, which, as near as I can tell, means the second a home becomes vacant, people rush in and take out anything of value in that home, including all of the copper piping and the appliances, and turn the thing into an unlivable site, basically. So, so all that's going on, but come the end of the day, you're going to have some kind of return on this thing that's roughly equivalent to what you paid. So that's what we did. So we put this whole thing together. We managed to do 5 of them before you actually have to get a mortgage license, and we had to deal with the issue about where in the world we were going to get the money to do any more. And so we got up one day and said, well, all right, we've really got to get something going here, because we think if we can do it in Massachusetts, you can push this out across the country. And we set ourselves a goal of raising $50 million. Well, it's great to get up and set yourself that goal, and the next day you think, what am I going to do? How am I going to find the $50 million? And it turned out, actually, I thought for a period of time it was going to be the toughest money we'd ever had to raise. I would say that it actually came in faster than anything we've ever tried to raise. It came in primarily through high net worth individuals who were looking at what was happening in Boston, had made a lot of money on the upturn, and were actually eager to do something that made sense. We also have folks from the Kresge Foundation, a little bit of money from the state, and a variety of other players coming in with us. And we set out actually to do this. So what's happened, fast forward to the present, we've now, since the turn of the year, done about $11 million worth of mortgages. We've been able to help almost 100 families stay in their homes. And the goal here is actually to stabilize neighborhoods and families by never having anybody leave, right? So instead of having a vacant house that you then have to fix and move somebody back into, what you have is somebody who's in foreclosure who stays right there in that house. So the kids never have to switch schools, they don't have to change friends, the parents continue to contribute to the neighborhood. There's no instability in that process. We've been buying at roughly 43% of outstanding mortgage value. We mark it up about 25%, which takes care of that difference between distressed values and market value, and also helps us to build loan loss reserves over time, because we know with the unemployment level the way it is, there'll be some losses here. We put the shared appreciation mortgage on, and on we go. So let me just give you a sense of what this really means. What we've done basically is to take folks who have, on average, a monthly housing expense of about $3,200 and knock that down to about $1,600. It's a big knock. So once you've done that, you actually wind up with an affordable house. People can afford a $1,600 house. They can't afford a $3,200 house. So what are the problems? We got a bunch of problems. One problem is that when you try and buy a home from a lender or a servicer, or even if it's post-foreclosure from an asset manager, part of the concern they have is they say, well, if I sell this home at half price, isn't everybody else just going to want to stop paying their mortgage? Well, maybe they are, but I don't know anybody who's willing to pay twice market for an existing home, right? So the lenders or the servicers or whoever has got these things, and the reason I'm vague about it is because it's all over the map who actually has control of the mortgage. And it turns out, of course, they're not really so sure has control of the mortgage either. But one of the great challenges that they have is they can do nothing, right? Which means that they're not collecting anything on the mortgage, and eventually what they're going to get is market value for the home, distressed market value, or they can work with us to pay and receive distressed market value today. Now you might think that what they would do is to say, well, a bird in the hand is worth 2 in the bush, I'm just going to do this today. That's what I thought too, but I will tell you that one of the most difficult pieces of this thing has really been getting lenders and services to focus and to actually agree to do some of this. And it turns out that part of the reason for that is that if I'm a servicer, even if the home I'm working on is in foreclosure, I continue to get my fee. So I have almost no incentive to actually proceed more quickly. The other piece of this, which really surprised me, is that if I'm part of a securitized pool, that is, I'm getting income from the various mortgages, even if those mortgages aren't paying, I'm still getting my share of income from the whole. Now, this is a bit of a fool's errand, if you ask me, because all it means is that pool is shrinking dramatically. But today, at least, before the home is actually foreclosed upon, I continue to collect. And lots of the securitization agreements that were written, stunningly enough, don't really say what happens if you have a market downturn, and really don't describe what happens between the various tranche holders. That is, people who get the highest level of income, people who get, versus people who get money only if the more risky loans pay. So the servicer sits there and says, geez, you know, if I foreclose, not only don't I get paid my fee, but I'm now at risk of being sued by all of these various participants in the securitization instrument, so why do I want to do anything? So what to do about that? And I think there are some very interesting policy considerations here. I am operating on the assumption after last Tuesday's election that while we are just fine here in Massachusetts, perhaps the rest of the country is not in quite as good shape. And I'm not certain that we'll see any landmark legislation for the next 2 years, particularly when it comes to cleaning up this mess. So partly I'm sort of thinking about what kinds of regulatory change can occur within the existing structures, whether it's Fannie or Freddie or the Federal Home Loan Bank or FHA or any of the folks who are around right now. So one thing I think to think about is to provide a safe harbor for servicers. That is, if a servicer sells at market price, and particularly perhaps even sells to a nonprofit, a group like Boston Community Capital, they're immune from suit by the members of their securitization pool. I would also say if the members of the pool want to fight about who gets the money, fine. Put it into escrow. They can fight till the cows come home, but in the meantime, at least, the docket is being cleared and the neighborhoods are being stabilized. So that would certainly be one piece. A second piece, I think, is there really needs to be an alignment of incentives. You know, Chip was talking about the markets clearing. And I'll tell you, I mean, I've thought now for 3 years that we're behind the curve in this. I expected they would clear in the fourth quarter of 2008. It didn't happen. I expected markets would clear in the fourth quarter of 2009. It didn't happen. And I can tell you with a fair degree of certainty, I no longer expect it, nor will it occur in the fourth quarter of 2010. That was really one of the first things that caused me to understand that this was a wildly different circumstance than others that we had known before. But I think that we need to create, to shift the incentives so that we actually do create incentives for the markets to clear. And there are a variety of ways to do that, right? I mean, you could increase the reserve requirements for anybody holding these mortgages in such a way that would actually encourage them to take them off the books. You could require that they mark to market in a way that would actually substantially negatively impact the balance sheet. But I do think trying to realign the incentives is probably a really important thing. I also think Massachusetts has done some wonderful work with respect to protection of tenants, because part of what happens is when a home is in foreclosure, the entities that hold those loans, and in that I'm going to include Fannie and Freddie since they actually seem to maintain this policy as well, they have this idea that the home ought to be vacant in order to be sold. And from our perspective, I think from the community's perspective, nothing could be farther from the truth. The more vacant homes you have, the worse impact you're having in terms of neighborhood stability and neighborhood values. So anything that can be done to shift the perspective of Fannie, of Freddie, of the FHA, of the services, all of the folks around with respect to keeping people in their homes, whether they're in foreclosure or not, I think would be absolutely critical. And I think the Mass Legislature did a terrific job in saying that tenants have to remain in place now unless in fact they're not paying their mortgages. So that's a second thing. A third thing is, I gave a talk out in San Francisco last week in which I quoted Audre Lorde, who many of you probably know. Audre Lorde described herself as a black lesbian mother warrior poet. And she wrote an essay entitled, "The Master's Tools Will Not Dismantle the Master's House." And you know, I think she's right about that, but I think that the Master's tools can be very, very useful in adding a new room to that house. But what I mean by that is we need to think about using secondary market sales in order to support the kind of work that we're doing. So one of my great challenges is the money that I've brought in is 5-year, 4.25% money. I'm lending it out for 30 years. Now, I don't know if there are any bankers in the room, but it doesn't take much to see I've got a real asset liability mismatch. And the only way I'm going to get through that problem is if I can take the income stream from those mortgages, sell it into the secondary market, and recapitalize. So I'm now out talking to folks like Credit Suisse saying, well, yes, every single one of my borrowers has been through foreclosure, and no, they don't have a credit score that anybody is prepared to live with. But in fact, we're providing lots of servicing, and I can tell you that since the turn of the year when we did this, I have a 0 default rate. right? And I don't anticipate it'll stay at 0, but I do anticipate it'll stay in the very low single digits, and I think that this is a useful instrument to sell. So again, anything that we can do to create some incentives in the secondary market for the sale of those instruments and for the sale of pools derived from those instruments, I think will be absolutely critical in blasting this program outside of the greater Boston area and really across the country. And then I know we're getting close to break here, so let me just talk about 2 other quick things. One is, I want to talk about rental versus home ownership. Now, home ownership for a long, long time has really been the basis in this country in which families create wealth. And there was a wonderful book written back in the 80s called Black Wealth, White Wealth, written by Tom Shapiro, who was here and I think still is here, and Mel Oliver, who at least last I knew was a vice president of the Ford Foundation. And really what they talked about was that you could look at disparities of wealth among communities of color and white communities and really focus on the fact that because there was so little wealth at a parent generation, the next generation down never got to buy a home if you were in a community of color, and in that way never began to develop net worth. And so it's just another piece of the paradigm here, which is we all understand that the way long-term to create wealth is to buy a home. So if you're a renter, you don't get that benefit, right? So, but if you're a renter, you also have some mobility with respect to where work is. You don't necessarily get caught in the long-term ups and downs of a real estate market. So I think one of the things for us all to think about is, are there some ways to create value for renters so that in fact there are some significant family net worth incentives to rent? Now the other way to do this, of course, is to reduce the value to homeowners, but I don't know, I'm not certain I can roll a ball up that hill. I mean, that's a pretty widespread entitlement. But I would like to spend some time thinking about, is there some way to create value for renters? You could imagine a phantom interest in the appreciation of a property. Imagine a number of things, but I think that's something really to think about. The second thing, I think, is really thinking about what it takes to maintain a portfolio of disparate site affordable housing. One of the things we're doing, in addition to looking at the foreclosure issues, is sort of looking around Boston and saying, okay, prices are at the bottom, or maybe they're not at the bottom, but they're pretty close to the bottom. Is there a way to buy up real estate today and maintain it as affordable over time, right? But the challenge with that, and every community development corporation that's trying to do this has run into this problem, the challenge is really trying to figure out how to manage that property over time in a way that makes sense. So one of the things we're doing, I sometimes joke and say that with respect to the foreclosure work we're doing, and I should tell you, we call it the SUN Initiative for Stabilizing Urban Neighborhoods, that one of the things we've done is to recreate the community bank, right? You know your customer, you actually underwrite the new service, there's a real human being that they can talk to as opposed to a voicemail and so forth. And I think maybe the next thing we need to do is really recreate the immigrant form of property management, right? And in my own family, my grandfather came here from Svislovich in Russia long about the turn of the 20th century and managed with his carpenter's tools to buy one home and another home and another home. And of course, by the time he was done, he had, 6 or 8 or 10, and he could manage them. We need to think about, are there some ways to do that now? Are there some ways to take folks who are in those homes, give one or more of them responsibility for managing on the ground, have a supervisory management, sort of set of personnel around so that you maintain the cost of that, reduce rent or maybe have no rent for the folks who are doing the managing, but in some way move back from this kind of notion of professional management to a much more community-based kind of management that's more affordable, that builds skills in the folks who live in our communities, and that really does mean that people know each other and are actually dealing with their neighbors. So let me stop there rather than going further so we have time for questions afterwards. But that's the view from the street. And I will say one of the great things about following Chip always is that I get some comfort in knowing that what he's seeing at the grand scale is also what we're seeing at the small scale. So I generally know we can't be too far off base. Thanks very much.